Welcome back. You're watching Your World at 10. Joining me now, Sarah HEWIN, Regional Head of Research for Europe in the Global Research Department at Standard Chartered Bank. She joins me now from London with her perspective on the effectiveness of that up to €100 billion bailout for Spain that was announced on the weekend. Sarah, thanks very much for joining us. I know this is probably a question you've been asked a dozen times today, but do you think that up to €100 billion is going to be sufficient to help plug the hole in Spain's banking system?
Well, it should be more than sufficient. The €100 billion that the Eurogroup finance ministers have offered to Spain is really at the top end of the estimations of how much Spain's banks could need for recapitalisation purposes. So we're waiting to hear from independent assessors over the course of the next week or so exactly how much the banks need. But the chances are that it'll come in lower than €100 billion.
I know that we're awaiting full details of how this banking bailout will work, but nonetheless, do we know whether the money will come from the ESM or the EFSF, and if that makes any difference at all, and whether there will be any conditionalities attached to that money, because we're already hearing little rumblings from Greece and other countries that have been bailed out saying we've had a bunch of conditionalities imposed on us by the Troika. Spain seems to be getting the money easy.
Well, this is an unusual sort of bailout in that it is targeting just the banking sector. So other bailouts for Greece, for Portugal, for Ireland have gone to the government, and they've addressed overall funding needs, although obviously in the case of Ireland those funding needs were pretty directly related to the banking sector. In terms of whether the EFSF or the ESM are tapped, it depends largely on when Spain makes the formal request for funding. The European Stability Mechanism, that's the permanent bailout mechanism, is not yet operational. We're awaiting ratification by individual euro area governments, and although it was due to become operational from the 1st of July, that date is slipping. We've heard the 9th of July. It may be that it's later on in July that finally the fund is up and running. So obviously, if it's not operational, then Spain will have to access the temporary bailout mechanism, the EFSF. Now, there are problems associated with that, the main one being that Finland demands collateral in the event that the EFSF is tapped. There could be ways around it, but it's not as straightforward as accessing the ESM. The one problem about the European Stability Mechanism is that it has seniority over other government funding. So, of course, that would, at a stroke, put holders of Spanish sovereign debt at a disadvantage.
It's interesting that you bring up Finland, Sarah, because I know that the Finnish Prime Minister today seems to have suggested that some of the bailout money, or all of the bailout money, should go to bad banks and should go to good banks in Spain that have a chance of surviving, and that the bad banks must all be agglomerated into a single bad bank, and a way of dealing with that or selling that down should be found. So how quickly is this money going to get to Spain's banking system? Do we have a timeline at all in hand?
We don't have a timeline. The Eurogroup offer over the weekend was a preemptive action, largely, I think, to do with the fact that we have Greek elections coming up on the 17th of June, which could promote turmoil in the markets. And I think the idea was to preempt any particular turmoil around Spain by making it clear that European funding is available for the Spanish banks. But we need to wait for a formal request from the Spanish government. That will come through once they have an understanding of exactly what the recapitalisation needs are of the individual banks, and that information should be coming through in the course of the next week or so. I think that the comments from Finland are entirely justified. There's no point really recapitalising banks that then, a couple of years down the road are going to to need further capital injections. You really want to make sure that you're supporting those banks that have a good chance of surviving and thriving, and banks that aren't in that situation should indeed be merged or somehow sort of dealt with in a way that doesn't continue to suck money out of Spanish and European funding pots.
All right, before I get to the Greece election on the weekend, I've got to ask you this. What does this mean for Italy's banking sector, which is also under pressure? And do you think that this move made over the weekend, and like you said, it may be in anticipation of turmoil ahead of the Greece elections, is going to be enough to deal with that kind of turmoil? We've seen a rise in Spanish 10-year yields over the last few weeks. It has risen above 6%. We had seen yields come off in the first part of the year, and they've rebounded since then. So is this 100 billion, up to 100 billion euro announcement really going to be enough in that sense?
Well, the Italian situation is different from the Spanish one in that the Italian banks are on a more secure footing. The problem with Spain is the savings banks in particular that obviously are in need of substantial amounts of capital to survive. Italy's banks have been more cautious. You don't have those sorts of problems. Having said that, the Italian government debt level is much higher than Spanish government debt, and so they have high rollover requirements. It's all down to confidence, of course. If markets have confidence, then borrowing costs for Spain and Italy are manageable. If that confidence dissipates, it starts to become more costly and potentially more difficult for Spain and Italy to borrow on the capital markets. And this is where the Greek election comes in. The results of the Greek election could have a very significant bearing on whether Spain and Italy can continue to access capital markets for government financing needs, at least in the very near term.
Do you think it's the most likely scenario, whichever way the Greek elections go, that Greece will insist on renegotiating its bailout terms simply because it's unable to deal with the kind of austerity that it has had to over the last several months, that is dampening growth or making the matters worse? And in the face of that renegotiation of bailout, this contagion and confidence issue that you talk about will not be soothed by 100 or 200 or even 300 billion euros.
I think a lot does depend on the outcome of the election. You're right that in all likelihood, whichever government comes to power in Greece, they will have received a message from the electorate that the terms of the bailouts are very onerous and that the population is struggling under austerity. So it's likely that whichever government comes to power, they'll be sitting down with their euro area and IMF creditors and coming to some sort of arrangement about where to go from here. The difference will be really on whether there's a confrontation between Greece and its euro area creditors. The sort of language that we've had from the left-wing coalition has been quite hostile, quite confrontational, and demanding a renegotiation of the bailout. Essentially, that results in new money needing to come through from the euro area, and I think that creditors are going to be very reluctant to deliver new finance under those sorts of conditions. So sure, I mean, if we get a confrontational and hostile government coming to power in Greece, then the 100 billion euro bailout for Spain's banks will probably need to be supplemented by additional bailouts for the Spanish government and potentially some temporary bailout facility for the Italian government as well.
I guess Alexis Tsipras is the man of the moment. The world is watching him closely, and we will know more on Sunday as that